Every trade needs to answer four key questions. What directions the price is trending? How far is the trend likely to go? Where can you enter a trade with the best risk-reward ratio? And most importantly, and what point you are definitely wrong. Elliott Wave theory answer all these questions. The wave principles helps to spot high probability trade opportunities, improve the trade entry with a solid money management, including stop losses and traders. Today I am sharing several crucial tips that will definitely improve your trading no matter if you use Elliott methods or you simply decide to use price action. So if you could subscribe to the channel and stick around for the full video. Write down the main Elliott rules. Nothing is more important in Elliott wave analysis than respecting the Elliott wave rules. Each wave pattern has a distinct set of rules which have been fulfilled in order to make pattern valid. If certain requirements are not met, some other patterns must be unfolding. As simple as that. It is therefore very useful to write down an Elliott Waves rules so that you can quickly check and confirm that your wave label is indeed correct. Wave 2 never pulls back more than 100% of wave 1. If it does this, the trend cannot be confirmed. Wave 3 cannot be the shorter of the wave that is too short. It means that is not correct wave account. Therefore, the next wave remains part of the third wave rather than forming wave 4 and 5. Wave 4 cannot go below the price of wave 1 if wave point is breaking below the wave point. First, it clearly tells us that this is not part of the fourth wave, instead it's carrying on within wave 3. Trade only in the directions of impulsive waves, price moves in impulsive and corrective waves. Knowing which kind of waves is likely underway currently and which type recent waves were will help you forecast what the price is likely to do next. An impulsive wave is a large price move and has associated trends. If it's an uptrend, it keeps reaching higher prices because the upward moves are larger than the downtrend moves that occur in between large upward waves. Corrective waves are the smaller waves that occur within a trend. For better results, you should trade in the directions of the impulsive waves because the price is making the largest moves in that directions. Impulsive waves provide a better chance of making a large profit than corrective waves do. You should use corrective waves to enter into the trend today in an attempt to capture the next big impulse wave. By during pullbacks or corrective waves during upturns and ride the next impulse waves as it takes the price higher. Sell during corrective waves in a downtrend to profit from the next impulsive wave down. The idea of impulsive and corrective waves is also used to determine when a trend is changing directions. If the market shows big moves upwards with a small corrective waves in between and then a much larger downtrend moves occurs, this signifies that the uptrend may be over. Since impulsive occurs in the trend directions, big downwards more larger than prior corrective waves and as large as upwards impulse waves indicates the trend is reversing. Use protective stops below waves 2 and waves for the stop loss always been the key to trending. This is the factor which will make you lose or make money. There are two particular rules that cannot be violated within every Elliott wave. Wave 2 cannot retreat more than wave 1. Wave 4 cannot enter the price territory of wave 1. Using these rules, Elliott methods will help you placing optimal protective spots. For instance, when trading wave 3, you will know that wave 2 cannot go below the low of wave 1. This means that the best location to place a stop loss order will be below the low of the wave 1, or the wave 4 cannot overlap with wave 1. This means that when trading wave 5, the best point to place a stop loss would be below the high of wave 1. The process is simple. You identify a possible Elliott cycles, you immediately check the rules to be sure all conditions are met, you enter during an impulsive wave and you place your protective spots accordingly. You can eliminate much of the concerns by analyzing these rules, and you will also minimize your losses to known amount. Learn to define the corrective structure accurately, so the best trade happens if you can catch the impulsive wave early on. But in order to catch those waves, you need to define the corrective structures accurately. According to Elliott, there are 21 corrective ABC patterns ranging from simple to complex. You don't have to memorize all 21 types of corrective ABC patterns because they are just made up for three very simple, easy to understand formations. The first one is the zigzag formations. The zigzag formations are very steep moves in price that go against the predomination trend. Wave B is typically shortest in length compared to wave A and C. The zigzag patterns can happen twice or even three times in a correction. The second one is the flat formations. Flat formations are simple sideways. Corrective waves in flats in the lengths of the waves are generally equal to the lengths in the wave B, reversing the wave A move in wave C upon the wave B move. And finally, the trending formations. Trending formations are corrective patterns that are bound by either converging or diverging trend lines. Trend lines are made up of 5 waves that moves against the trend in a sideways fashion. Their triangles can by symmetrical, descending, ascending, or expanding. Now, a lot of the pre-trade analysis has to go into knowing what kind of the corrective patterns is unfold so that you know when it will be complete. This will have a twofold benefit for the protecting you from entering trades too early, as well as not missing the boat when the price goes into the impulsive trend continuation. So look for divergence and end of the corrective waves. If you followed my channel, you must have noticed how often I use the word divergence, usually when I'm expecting a trend reversal. A divergence occurs when a price reaches a new extreme while the line of indicator does not. It means that despite the new high or low, the current trend is exhausted and might be about to end soon. Oscillator indicators are the best tool to spot the divergence. I personally prefer to add the stochastic or MACD histogram when I'm counting waves. Now, the easiest point from which you start a wave count would be at slight low at the end of the corrections. As a clue, corrections usually end in diagonals. At this point, divergence can be found in momentum indicators, just like in this example. Learn relationships between Fibonacci ratios in Elliott wave patterns. The application of Fibonacci ratios are an integral part of Elliott Wave analysis. Combining the Elliott Wave structures with Fibonacci offers high probability tuning points and where the next price moves will likely terminate. Therefore, counting waves and applying the approaching Fibonacci levels is essential step for every Elliott Wave trace. There are the common relationships between Elliott Wave and Fibonacci levels. It is important to write down or pin these levels so that you know how the price actions is most likely play out. Wave 2 50% or 61.8% wave of wave 1. Wave 3 161%, 261% of wave 1. Wave 4 8% or 50%, 61% of wave 3. Wave 5 100% of wave 1 or 161% of wave 4. Projection to the end of the wave 3. If you don't like using Fibonacci, you can use simple price actions to trade and find projections for Elliott Waves. To begin with, you can draw the channel as soon as wave 1 and 2 are finished. Connect the origin of wave 1 and the end of wave 2, then draw the parallel lines from the top of wave 1. These channels is considered as an absolute minimum target for the third wave under development. If the third wave can't break through the upper line or fails to reach it, then the trend is weak. Furthermore, the lower trend line is the channel serves as the stop loss. When this baseline gets broken, there is a strong probability that wave 2 gets more complex, those wave 3 has not begun yet. Keep in mind that wave 3 is normally the strongest wave and often will go far beyond the upper trend line. Projecting the end of wave 4, as soon as the wave 3 has finished, you can draw a channel connecting the end of wave 1 and wave 3 with the trend line and drawing parallel lines from the end of the wave 2. By doing this, you can project a target or wave 4. Keep in mind that normally the baselines from wave 3 will be broken slightly by the piece actions of wave 4. If wave 4 doesn't come near the baselines at all, this is the sign of the strong trend, so you draw the trend line from the beginning of wave 2 to the end of wave 3. Project parallel lines of the end of wave 2. You want to find out the endpoint of wave 4 so that you can trade the next impulsive waves. Projecting the end of wave 5 method 1. As soon as wave 4 has finished, you can draw a channel connecting the end of wave and the end of wave 2 and wave 4 with a trend line and draw parallel lines from the end of wave 3 and project upwards to wave 5. This is your target for wave 5. This would be a formal wave 5. An extended wave 5 would push higher in the price fails to hit the projected trend line to wave 5. Then the market is weak and you should look for sell-off. Projective the end of the wave 5 method 2. Most of the time wave 3 is the strongest wave, showing a very fast acceleration relative to wave 1 and 5. If wave 3 indeed shows nearly a verification rise or declines when the draw trend lines, wave 2 and 4 are drawn to parallel lines from wave 1. These parallel lines will cut through wave 3 and will target wave 5. From my experience, this is very variable channel. Liquidity is essential for the consistent Elliott Waves behavior. Liquid markets are by definition trades by the large crowd of traders. Although it is nearly impossible to determine what a single trade will do. It is possible to estimate statistics probability of what a large crowd of traders will do. Mass crowd psychology comes into play. The rules of mass human emotions at its length from fear to hope, go greed and back again. Liquidity is essential for consistent Elliott Waves behavior. Stocks such as those of S&P or Nasdaq's and crucial, for example, show strong and dependable Elliott wave patterns. These markets are driven by mass psychology or human emotional. They are truly liquid, driven by supply and demand. Conversely, tiny traders mix do not show consistent Elliott behavior. This is also the reason why markets what are manipulated by the few large traders, institutions, or governments are often poor candidates for Elliott analysis. So be careful on which markets you decide to apply your Elliott wave analysis. If you found value and want something, you will select. This is the way we will know that you like some of our videos. Until next time.